This is task 3 from the second sample assessment for personal tax. Task 3 is about income from investments and property. So let's have a look at part A of this question. So the information below relates to the investment income received during 2024-25 by two taxpayers. And we need to complete the following statements and enter our answer in whole pounds only, and if the answer is 0, we need to enter a 0. Remember, we need to follow the instructions in the exam, or the computer-based exam software will not recognise your answer and give you the mark. So in part 1, Miss W receives a dividend of 4,500. Her other taxable income after personal allowances totalled 42,400. The tax payable by Miss W on these dividends is... Okay, so we've got this dividend income of 4,500 and we need to identify whether there's any allowance for this. So let's have a look at the tax tables to see this. So we can see in section 2 of the reference materials that there is a dividend allowance of £500. So this will not be taxed. And if you look at section 1 of the tax tables, we'll see that the dividend rate will depend on which band we fit into. So there's the basic rate, higher rate and additional rate band, and we have different tax rates for those. So we need to identify which band Miss W fits into with her dividends. So the way we're going to do this is to remember that all the various types of income stack on top of each other. So we have our basic rate band and our higher rate band, and then above that we have our additional rate band. And we're going to start off with our general income. It tells us that her other taxable income after personal allowance totals 42,400. Now in the reference materials we see that the basic rate band covers the first 37,700, so her general income takes us above the basic rate band, so when we've got the 42,400, and then some of it is taxed at the higher rate band. And then on top of that we have our dividend income, so we've got 4,500 of dividend income. But remember that 500 of this is part of our allowance and would be taxed at 0%. So that means of that 4,500, we have 500 at 0%, and then we have the remaining 4,000 taxed at the higher rate dividend rate of 33.75%. And that gives us 1,350. So that's how much the tax payable on these dividends will be. Then in part 2, Mr. F received 5,200 in interest from his building society account and £720 in interest from his individual savings account. So remember, the individual savings account is tax-free, so it's a method that the government is trying to encourage us to save, and so we don't have to pay interest, or we don't have to pay tax on interest earned on those ISAs. Now we're also told that from the other taxable income after personal allowances we have 34,780. So like before, let's see how our incomes all stack on top of each other. So we've got our basic rate band, our higher rate band and our additional rate band. And our basic rate band is 37,700. So we have our other taxable income. So let's put that on. So this is below the threshold for the basic rate band. So we've got our 34,780. And then on top of that, we have our interest income. So we have a further 5,200 of interest. So we can see that this pushes us into the higher rate band. So we need to work out then, based on that, what will be our allowance. Here's section 2 of the reference materials. So we're looking at our savings income, aren't we? We're a higher rate taxpayer, and therefore our allowance is £500. Now, it doesn't matter that some of our income falls into the basic rate. We are a higher rate taxpayer, so our allowance is limited to £500. So we know that some of this income from our investments is tax-free, but some of it may also be still taxed at the basic rate band. Okay, so I've not really drawn this to scale here, so I'm just going to sort of move my threshold here so that perhaps it can be a bit more obvious. So some of our interest income will still be at the basic rate band, and some of it will be in the higher rate band. Okay, so what we need to do then, if we compare these two numbers, we've got the 37,700 and the 34,780. So that tells us that there is a total in the basic rate band of 2,920. Now of that, 500 is tax-free, because that's part of our allowance. And then of the rest, we've got 2,420. That's going to be in the basic rate, so that's going to be taxed at 20%. And therefore, of the 5,200 total income from our investments, we have 2,280, which will be taxed at the higher rate. So when we multiply the amounts by the rates, so that means when we get the 2,280 times 40%, so that's going to incur £912 of tax. And then in the basic rate, we've got 2,420 times 20%, so that will incur 484 of tax. And then we have 0 for the allowance, so that gives us 1,396 in total. Okay. So for the question then, it asks us Mr. F's income from investment on which tax will be paid. So how much will be taxed? Well, that's going to be the total of these two numbers, which is 4,700. And then how much tax will be paid? So that's the number over here. That's 1,396. So next then, Mr. X owns and rents out 2 properties during 24-25. Relevant information on the properties is shown in the table below. So you need to complete the table to show the taxable rent and also what are the allowable expenses for the year. So the first property is called Windy Walk. So Windy Walk was let out for the whole of 24-25 for £1,070 per month. Okay, so we can work out our taxable rent, so that's simply going to be the 1,070 multiplied by 12. So we have rent of 12,840. And we're told that Mr. X pays 10% commission to a letting agent. So in February 2025, Mr. X paid 4,200 for an extension to the property. Well, that extension is a capital expense because we're adding to the building, and therefore that is not an allowable expense. So that means we just put our 10% commission as the figure for our allowable expense. That's going to be 1,284. Now, in practical terms, that commission may be deducted from the rent by the letting agent, so it might be that we only receive the net amount. But for our tax return purposes, we're going to put the full amount of rent as our income and then show the letting agent commission as an expense. Okay, so we wouldn't show the net amount that we actually receive in our tax return. We'd show them separately. And then for Cold Cottages, this was let from the 1st of November 2024. So we need to identify how many months rent were received in the period. And the best way to do this is just to work through on your fingers, counting along. So we've got the 1st of November, 1st of December, January, February, March, and the 1st of April. So remember, the tax year ends on the 5th of April, so we do receive rent on the 1st of April. So we have 6 months of rent to receive. So rental income is based on the cash basis. Okay, we appreciate that that 1st of April rent payment is for April, and most of it hasn't happened yet on the 5th of April. We've only had 5 days, but it doesn't matter. We just do this on a cash basis. So, and we receive, it tells us then, £670 per month for the rent. So 670 multiplied by 6 gives us income of 4,020. And then Mr. X paid £300 for advertising for new tenants, and that's a perfectly allowable expense. And then finally, we need to identify whether these following statements are true or false. So landlords can claim insurance paid on rented property as allowable expense. So yes, that's true. That's just a day-to-day expense. That's perfectly fine. And then the cost of improving a property prior to renting it out would never be an allowable expense. Okay, well, improving the property is normally a capital expense, so that would be false. But we just need to be aware of the word never. And this is something to be aware of in your exam as a technique. The word never and the word always need to be looked at very carefully, because there could be an exception. And in this case, is it never an allowable expense? Well, no, it's not. The answer is false here, because if we are trying to build up the property to the standard that is sort of in modern day terms, then that would be okay. So for example, if originally we had single glazed windows and then we replace them with double glazed windows, HMRC says that, well, yes, that is an improvement, but because double glazing is now the acceptable modern standard, then that's okay. That would be an allowable expense.